We're seeing the HSI up more than 1%. As Yvonne was saying, a bit of a catch-up after the holiday yesterday. Does the HSI now just look through these security law concerns? Does it look through the US-China trade tensions, the pressure that Hong Kong and Beijing is coming under internationally over this security law? Can it just grind higher now into the second half?
Yep. Thanks for having me. So we believe that the market has largely priced in the passing of the new law. Investors tend to focus on the predictability. So if the HK situation stabilizes, I think we should see confidence returning to Hong Kong as a key financial hub. Hong Kong continues to be an attractive destination for Chinese companies seeking to IPO, and the depth of the market has never been better, with many of these top Chinese internet companies choosing to have their secondary listing in Hong Kong. That said, we think that the international responses to the law will need to be closely monitored.
Do you agree with many others who say that if you want exposure to Hong Kong, you want to be making sure that you're adding companies that are domestically focused, as in domestically on the mainland, rather than focused on Hong Kong? Is that where you stand as well?
Yes. So most of our exposure is in companies focused on domestic consumption and import substitution in China. We have minimal exposure to companies that derive a majority of their revenues from Hong Kong. We think that the economy is still suffering from the twin impacts of the social unrest and the coronavirus. So we do not expect to materially change our Hong Kong weight at this point, given that tourism will take some time to recover. And in the longer term, there is limited growth for Hong Kong domestic demand.
Wei Wei, you say you're looking closely at the response from the U.S. and Western powers over China. What specifically do you need to see for this to trigger some type of correction in the Hang Seng market again?
I think most of what the U.S. has done at this point, including some of the trade sanctions on Hong Kong, has largely been digested already by the market. So I think the bigger thing to watch out for would be what U.S. does to China and then how that will impact our holdings in China.
Your growth equity fund, as we mentioned, has beaten most of your peers this year. Tell us what you're doing right, and what have you had to adjust after the comeback we've seen in the previous quarter?
Right. So key sectors that have worked well for us this year include education, internet software, and consumer staples. The portfolio is mostly focused on stocks that benefit from domestic consumption and import substitution. We think that there's abundant liquidity in the market now due to the global central banks easing. And without a vaccine, we think that the market will continue to focus on companies which are able to provide defensive growth and earnings visibility. Especially right now, we are seeing a second wave with the global economy reopening. So it now still makes sense for investors to buy companies that benefit from this new normal.
Wei Wei, are we at the point now where we can look at China, we can see the economic data is improving gradually, slowly, that improvement is coming through. Can we then switch our focus to cyclicals? Can companies in the infrastructure space, for example, benefit, the energy space, financials?
So we think that the infrastructure space offers attractive growth at reasonable valuations compared to the run that we've seen in consumer staples and tech. The infra space is one of the key sectors that the government is stimulating in order to kickstart the economy post-COVID. So we like some key national champions within the space. For example, Sany Heavy is the leading excavator maker in China, and it's a play on localization and import substitution. Valuation right now is undemanding. It trades at 11 times FY21 PE on consensus earnings. So we think that the market might start to look at these names as the economies open up.
Wait. Everyone's been talking about this rotation out of growth into value. That lasted for a couple of weeks, I think, but largely that trade hasn't exactly played out. You're saying here that the value part of the market has been ignored. What are investors missing?
Well, I think most investors right now are still very much concerned on the second wave and even a potential third wave. So the key focus right now is still on defensive growth. And until I think we see more positive news on the vaccine, most people would continue to be long on these names. I think value will start to perform when we see that there's possibly a lot of positive news on a vaccine, and then we see that economies open up without too much issue, I think then we can start to look at the cyclical names.